All right, everybody ready? Want to get started? Okay, welcome back. Class 7, today's the last weekend we'll be together. Today we are going to start talking about M&A. And just the roadmap for the rest of the way, today we're going to talk about merger modeling. So we'll just spend a little bit of time in PowerPoint on the lecture, then we'll go and we'll build a merger model, a shortcut M&A model in class. And then after that we're going to talk about the M&A sale process. So what do bankers do once they've been engaged by a company to sell that company? What is the process that gets followed in doing that? We'll probably get done a little bit early today. We typically do. And then tomorrow we'll start off, we'll talk about the pitching process, the process bankers use to go sell their services and market themselves. We'll also talk about recruiting, interview questions, that type of thing. Also kind of a course review, some of the key concepts. So that's the roadmap the rest of the way out. So let's talk a little bit about a shortcut model. All right, again, this is what we're going to be building in class, and this is basically a model that bankers can quickly use to figure out the impact on a buyer's earnings per share of doing a particular M&A transaction. All right, and specifically what we're looking for is we're looking to figure out, is the deal accretive or is it dilutive? All right, let's first define those. What do I mean by accretion or dilution? Who can tell me? On a per share basis. Yeah. On a per share basis. So if we talk about earnings per share, everybody's probably heard this, especially if you've ever read an analyst report, they talk a lot about earnings per share. Earnings that are available to the common shareholders of the company. The way that's calculated is net income divided by shares outstanding, fully diluted shares outstanding, right? Always on a fully diluted basis. And when we talk about this in the context of M&A and figuring out whether a deal is accretive or dilutive, what we're trying to say is, does the deal make earnings per share go down or does it make it go up? Okay, is it dilutive to the shareholders or is it accretive? Real simple, all right? What happens to EPS? Does it go down? Does it go up? Is it dilutive or is it accretive? Does that make sense? All right, so that's what we're trying to measure here. The reason we try and measure this is because obviously the market pays very close attention to earnings per share. Like I said, any analyst report will talk about it. Anytime a deal is announced, you'll typically read somewhere in that press release what the buyer believes is going to happen to their earnings per share. You'll hear things like, we believe it will be slightly dilutive based on LTM earnings per share, but we believe based on cost synergies and whatnot, it's going to be accretive to earnings per share in year 1, year 2, and beyond. All right? And because of that, it's a great deal. You should buy our stock, etc. All right, so that's basically why it's done. And it's used, whenever a buyer and a seller are public. All right? But even if the buyer is public and the seller is private, you'll see this deal being done as well. All right, again, this is focused on what happens to the buyer's earnings per share. If the buyer is public, this is going to be a very important analysis to conduct. All right, so here we have a quick example. If there's any dilution in the share price, assuming a constant PE multiple, right, in this case a multiple of 10, if before the deal there was a current share price of 10, earnings per share of 1, all right, if after the deal it's a dilutive deal, it drives earnings per share down to 90 cents, then if we apply that 10 times PE multiple, we'd see a corresponding 10% dip in the stock price. All right? Pretty important. When a CEO is getting compensated on what happens to the stock price, if the stock goes down 10%, that's going to be a major issue. So let's talk about a few of the things that cause dilution in the buyer's stock price. And again, when I say dilution, I'm talking about anything that causes this ratio to go down. So if we think just purely in mathematical terms, anything that causes this fraction to fall is going to be a dilutive deal. Right? So anything that causes the net income to fall, all right, maybe one of these things is the buyer buys a company that's losing money, most obviously. All right, the buyer buys a company that's losing money, net income declines, everything else stays the same, that'll be a dilutive deal. Make sense? All right. Another thing is if the deal is funded using a lot of stock. Right? So the denominator is going up, and maybe net income is staying the same, or the denominator is just going up faster than the numerator, that'll be a dilutive deal as well. Okay, but even if there's a deal where no stock is issued, maybe the buyer is paying cash for the transaction, that cash portion of the purchase price needs to be financed. Okay, and there are two different ways we can finance that cash portion. Either the buyer could borrow, right? What happens anytime we borrow? We get interest expense, we have more interest, and it could cause net income to go down. All right, so by borrowing the cash portion of that purchase price, that could drive net income down, that could be dilutive. Right? At the same time, the buyer might use even its own balance sheet cash. Well, if they use their own balance sheet cash, that's less cash on which they can earn interest income. They now have lower interest income. They might have lower net income as a result as well. All right? So it doesn't need to necessarily be a stock deal to be dilutive. Cash deals can be dilutive as well for those two factors, either borrowing the cash portion and incurring interest expense, or using cash from the balance sheet and losing interest income. Okay. Another item, and this is becoming less and less an issue as fewer and fewer deal fees can be amortized, but if the buyer incurs a lot of amortizable intangibles, that is, in this case, financing fees that can be capitalized, put on the balance sheet, and amortized over time, that amortization expense could reduce net income as well. Right? Again, less and less of an issue as accounting rules now allow us to capitalize fewer and fewer items. Right? And then the last thing we'll talk about is actually the first bullet point. If the target has a higher price earnings multiple than the buyer, and the buyer is issuing stock to do the deal, that can be a dilutive transaction as well. That one isn't, I think, as easy to understand as some of the others that we've outlined. But the transaction that we're going to model here in class, hypothetical transaction, will illustrate this. So let's say a buyer is trading their own stocks being valued at 10x, 10 times earnings. Seller, as part of the deal, the purchase price values the seller at 12 times earnings. The buyer issues shares. All right, that can be a dilutive transaction. They have to issue proportionately more stock to compensate for that higher price earnings multiple. Again, we'll see that in class. In the example, we'll see that basically shares outstanding are rising more quickly than the net income is rising as a result of the deal. So do these items make sense? I think they're pretty intuitive. And again, if you ever have any questions on this, think in purely mathematical terms. What causes the numerator to go down? What causes the denominator to go up? So when we build this shortcut model, the reason we call it a shortcut model is because as opposed to a full-blown merger model, we require less information. All right, so if we have the following items for both our buyer and our seller, if we have their fully diluted share counts, if we have their share prices, if we have their balance sheets, if we have their latest 12 months and their future earnings per share, and obviously if we know a little bit of information about the offer, specifically what's the premium being offered, what's the consideration, is it cash, is it stock, if it's cash, how much of that cash purchase price is being financed with debt versus balance sheet cash, etc. And then any debt that gets assumed in connection with the deal. We're going to spread a hypothetical transaction today where I believe it's Kraft buys Kellogg. All right, so we've assumed that hypothetically Kraft decides to make an offer to buy Kellogg. We've assumed a deal structure. And because we've already spread both companies, getting back to our valuation analysis we did in classes 2 and 3, we spread both companies. We have all this information, share prices, fully diluted share counts, balance sheets, etc. We can build a model around that, and that's basically what we're going to do in class. All right. Shortcut model is pretty straightforward to do. Again, a full-blown merger model, you're going to need a lot more assumptions. We'll review one of those later today, and I'll show you what's included in that. But again, after we've done this analysis, you'll have all the tools needed to do that. It's kind of a fun exercise. So at the end of the day, what this model tells us is obviously, is a deal accretive or dilutive? I mean, that's what we're talking about here. But it also can tell us a few more items as well. It can tell us what is the pro forma ownership structure of the combined companies. All right, that is how much of the combined entity does the buyer shareholders own? How much is owned by the selling shareholders? Right? In an all-cash deal, it's 100% owned by the buyer. Right? But you'll see in a stock deal that ownership can be a little different for each company, depending on the exchange ratio. If the deal looks to be dilutive, we're going to be able to calculate something called pre-tax synergies required to break even. What are synergies?
Synergy is a 2 plus 2, 5 concept.
Yeah, 2 plus 2 is something greater than 4. All right, so buyer buys a seller, maybe because of various aspects of that seller's business. The buyer can shut down some underperforming locations, they can reduce headcount, they can cut expenses, and create some additional income for themselves that way. All right. So if the deal immediately looks to be dilutive, we can calculate, we can back into, well, what would be the amount of pre-tax synergies required in order to make this a break-even deal? All right. That is, keep earnings per share the same after the deal as it was before. Okay, and then we can also, like everything else we do in banking, we can put together a lot of different data tables, look at different structures, different premiums that we might pay that would make the deal less dilutive, different structures of that consideration, maybe borrow some of the cash, maybe fund it off our balance sheet, maybe issue stock. All right, so you'll see at the end of this, we can create a lot of data tables to figure out what the deal could look like under different scenarios. All right, a couple items to keep in mind. Fully diluted share counts of the target, just like when we did our precedent transactions approach, must take into account the automatic vesting of options. Remember, options vest on change of control. This would be a change of control transaction. So this would be a change of control transaction. Those options would vest. We would determine, based on the offer price relative to the exercise price, how many of those are in the money. We would do our treasury stock method and calculate fully diluted shares based on that automatic vesting. All right, so that's one thing to keep in mind. All right, the second thing to keep in mind is the consideration used to finance the purchase of the equity. Are we issuing stock? Are we paying cash? Kind of talked about that before, and how that impacts either interest expense or interest income if the company's either borrowing to fund the cash portion or using balance sheet cash. And then pro forma ownership, most of the time, obviously, the buyer is going to want to control more than 50% of the target after the deal. Not always the case. Sometimes you'll see reverse mergers, but for the most part, that's typically true. Pre-tax synergies, we touched on this before. Again, if the deal looks to be dilutive, we can solve for how much in the way of synergies are required to break even. The theory being that if the buyer is able to achieve that amount of synergies, let's say 100 million of synergies, if they can achieve that, then the deal will be break even, will not be dilutive, and it would ideally have a minimal impact on the buyer's share price. What happens when a deal typically gets announced? What happens to the buyer's share price? What happens to the seller's share price when a transaction gets announced? Yeah, seller usually goes up, all right? Buyers typically need to offer a premium to the seller's share price. So if a seller's trading at $30 a share, a buyer's going to have to probably offer 35 or 40, something in that range maybe, to get the deal done. The seller's shares will typically trade up, usually to just a little below where that offer price is. Sometimes more. If an unsolicited offer gets made, say the buyer goes in, makes an offer at 35, but the market still thinks the deal's undervalued, the seller is resisting the transaction. All right, think of Kraft and Cadbury right now. Sometimes those shares will trade above the offer price because the market thinks the buyer's going to have to come back and offer more. All right, so typically the seller's shares trade up, and typically the buyer's shares trade down a little bit. And one reason is, number one, that premium. They've got to finance that premium. And secondly is the question of whether or not the buyer's really going to be able to get synergies out of the deal, whether the deal is actually going to end up being accretive or a good deal for the buyer's shareholders. And I think historically, if you look back, all M&A activity, and there have been studies done, but most M&A activity has actually been found to have destroyed shareholder value. All right, most deals in the long run end up being dilutive, and usually that's because of that control premium needs to get offered up front. and the buyers just usually aren't able to integrate the transaction and really make it pay for itself over time. All right. So the market is skeptical, as well it should be, that these deals can actually work. All right, calculation for pre-tax synergy is pretty straightforward. Again, we're just solving for what the amount of synergies would need to be. You'll see this in the model when we get into it. All right, we'll solve for the amount of synergies to make the deal break even. And once we know what that pre-tax synergy amount is, say 100 million, 200 million, or whatever, a lot of times what we'll do is we'll look at that as a percentage of revenues, maybe a percentage of EBITDA, maybe as a percentage of operating expenses, all right, to see exactly how feasible it would be. If the buyer's got to cut 50% of its operating expenses to make a deal work, it may not be the best deal. All right. But if their synergies turn out to be a very, very small percentage of revenues or EBITDA or operating expenses, the market might say, okay, that makes sense, that should be doable, and this should be a good transaction. All right. So that's typically how that's used. Exchange ratios, collars. I'm certainly not going to read all the text on this. Basically, I would say read through this on your own time at some point. This basically says that when a deal is structured, typically there'll be what's called an exchange ratio. All right, if there's going to be stock offered in the transaction. We're going to teach you how to calculate the exchange ratio in a moment. And the exchange ratio basically says for every share of the seller's stock, how many shares of the buyer's stock are being offered. So sometimes it's, maybe it's 1 share. Typically it's a fraction of a share. A half a share, 0.67 shares, 1.5 shares, etc. All right, we're going to teach you how to calculate that in connection with our hypothetical deal. But the buyers and sellers can also put in things called collars, really meant to lock in ranges of value and ensure that the buyer doesn't end up having to pay way more than it expected to pay. The seller doesn't end up having to take way less than it expected to take when the deal finally closes. All right, because again, if it's a stock deal, stock prices can fluctuate between the time a deal gets announced and the time it closes. And so if the buyer's share price goes way up or way down and it's a stock deal, that can affect the consideration to both parties. Goodwill, also not going to spend a whole lot of time here because we've talked about it, I think, on several occasions now. Goodwill is calculated as the difference between market value and book value, and it can no longer be amortized. All right. Other things that can no longer be amortized, a lot of different deal fees cannot be amortized. The only thing fee-wise nowadays that can be amortized are financing fees. So if the buyer raises some debt to finance the deal, then the fee associated with that debt can be booked as an asset, amortized over time. All right. Goodwill is not amortized, but tested annually for impairment, like we've talked about. Again, sensitivity tables will show you, we've already run through how to create data tables. These are some of the types that oftentimes are created. Figuring out what the range of share prices paid relative to the premium, ranges of considerations, ranges of options for how we finance that cash purchase price, the cash portion of the purchase price rather, PE ratios, accretion, dilution, etc. All right, so we'll see some of those when we get into the model as well. All right, so let's actually, before we get into any of this, let's open up the model. I want to show you what the model looks like. So if you go into your folder 6-7 merger modeling folder, what you're going to do is open the accretion dilution Kraft Kellogg shell file. And this is actually what we're going to be working in a few minutes. All right, so if you want to open that up, we'll just kind of walk through and show you what's contained in here. First thing I'll point out is, unlike a lot of our other models,